Everyone talks about growing revenue, but what if I told you you could double your business valuation without adding a single client? This isn't some trick, it's not a pitch, it's what serious buyers actually pay for. And most founders don't know this. So, if you're building towards an exit or just want your company to be worth more, this might be the most profitable 20 minutes you've ever spent. A client came to me recently with a solid business, 4.2 million in revenue, healthy profits, steady lead flow. He wanted to sell within 12 months. Thought he'd walk away with about 8 to 9 million. But what actually happened was when the buyers came in, they didn't see scalable systems. They didn't see documented processes. They didn't see a self-managing team. What they saw was exposure. They saw key man risk, which, in case you don't know what that means, refers to the potential negative impact on a business when it relies too heavily on a specific individual for critical information, like operations, knowledge, or relationships. So, if that person were to ever become unavailable for whatever reason, that can lead to disruption in operations, loss of expertise, or financial setbacks. And they saw complexity without clarity. And they priced that risk in, as they should. Final offer 4.9. Because the reality is, buyers don't pay for revenue. They pay for repeatability, stability, and transferability. So let's walk through what actually increases your valuation without touching your top line. These are real levers used in real deals. Number one is transferable value. Here's the hard truth. No one wants to buy a job. And if you are that business, that's exactly what they're buying. What buyers are really looking for is transferable value, something they can own, operate, and scale without needing you in the driver's seat. This means the business must be able to run independently. Your systems, your processes, and your structure, that's the value. Think about it like this. If someone buys a machine, they want to know it still runs when the engineer leaves. That's what your company should be. A well-oiled machine with SOPs, defined roles, and workflows that don't break when the founder steps away. When your systems are the asset, not your presence, your company becomes not just sellable, but valuable. Number two is operational infrastructure. When a buyer walks into due diligence, what they're really asking is how clean is the engine room? Do the departments talk to each other? Are there processes that reduce friction? Are your workflows clear and repeatable? Operational infrastructure isn't just about having systems, it's about how they connect. Cross-functional processes, automation, dashboards that track performance in real time. These things don't just run the business, they prove to a buyer that it's scalable. When you can show how the business functions without ambiguity or chaos, you don't just reduce the questions, you increase the trust. And the trust increases in multiples. Number three would be team autonomy and accountability. The moment a buyer sees that your team can operate without you, you've added value to your company. No one wants to inherit a business where all roads lead back to the founder. That's a liability. But if you've installed leaders, clarified responsibilities, and built a cadence of accountability, your company suddenly looks like a real organization, not a personality cult. Weekly reporting rhythms, team scorecards, decision-making frameworks, these give your people the power to act without asking for permission. And from the buyer's perspective, the less they have to replace, retrain, or restructure, the more they're willing to pay. Number four is documentation of everything. If your entire company lives inside your head, a buyer sees danger. Because once you leave, so does that knowledge. The fix? Documentation, SOPs for every major task, onboarding guides for new hires, playbooks that explain how to run the business day to day. It's not about micromanaging. It's about creating a bridge, one that allows someone else to step in, learn quickly, and keep the business running. Documentation de-risks the transition. It replaces uncertainty with clarity, and clarity is worth money. Number five is automation equals margin expansion. So let's talk bottom line. Every repetitive task that's still being done manually is dragging your margins down. Automation isn't just a time saver, it's a valuation booster. Because when we remove human error, reduce payroll bloat, and streamline operations, you're not just operating leaner, you're more profitable. And higher EBITDA with lower operational risk, that's gold in the buyer's eyes. Even simple automations like auto-sending client reports, onboarding sequences, or invoice follow-ups signal that your company is modern, efficient, and future-ready. That's the kind of business buyers pay a premium for. Number six is reduce buyer risk. Get a premium price. Every deal is a risk assessment. The more red flags they find, the lower your valuation drops. That means your job isn't just to grow the company, it's to de-risk the acquisition. Buyers are asking, what could go wrong if we buy this? Where are the gaps? Your goal is to have an airtight answer. Clean books, documented systems, accountable leadership, automated processes, all of it. When you can reduce their fear, you raise their confidence. And when you raise their confidence, you raise their price. You don't always need more revenue to get a higher valuation. You just need to build a business that's easier to buy. Look, you've been taught to chase growth, whether that be more clients, more sales, more top line revenue. But here's the truth nobody told you. Buyers aren't impressed by chaos that converts. They're impressed by systems that scale. So if your business only works because you work, you don't own a company, you own a job. And when it comes time to sell, they're not paying for your blood, sweat, or late nights. They're paying for the machine you built underneath it all. So build something someone else would actually want to own. But if you're serious about increasing your valuation without adding more stress to your life, start with something called the 7-level scale audit. It's a free tool that I created to help founders diagnose the real constraints in their business, like what's breaking, what's missing, and what's secretly dragging down the value of your business. It walks you through all 7 levels of operational maturity and shows you where to start. So click the link in the description below and take the quiz. And I promise it'll only take you less than 3 minutes at most. Whether you're 2 years away from selling or just want options on the table, this is where smart exits begin.